Hey everyone, welcome back to the channel, which is all about income-oriented investing, but not in today's video because today we're gonna pretend, or I'm gonna pretend, that I am a growth investor and tell you what I would buy if I was a growth investor, what ETFs I would invest in. So why am I doing this video? Well, number one, it was in my backlog. I always wanted to do this video. Number two, it ranked pretty high in the latest survey that I did, actually second place. So it's obvious to me that you guys are interested or curious to know what ETFs I find are the best for growth or total return oriented investors. And I know many of you watching, you probably do the income style, but maybe you do a hybrid approach where in one account or half you do have some growth investments. So obviously many people watching are not pure income investors like me, but take a hybrid approach, which is fine. And the last but not least, everyone, I feel, and I keep saying this and I'll say it again, keep saying it over and over. I don't feel that the income investing strategy is the best strategy out there. I just think it's the best strategy for me. I am not against the growth strategy or the total return strategy. I actually think it's a really, really good, proven long-term strategy that works extremely well long-term as well. So I am not against any investing strategy, everyone. I like the growth strategy. I think it's great. So in today's video, I'm going to give you my criteria, or my 7 criteria of what I would consider important if I was a growth investor. And after that, I'll take you a tour on some of the ETFs that I would strongly consider if I was a growth investor. Let's get started. So let's start with 7 criteria that I would consider or I would follow personally. Remember, this is just my opinion, everyone, if I was a growth investor. Criteria number 1, no single stocks. I would not invest in individual companies. It just increases your risk. I don't care what people say. You save on fees. It's a better long-term strategy. It increases your risk. There is no need. Passive index ETFs and ETFs in general have such low fees that, in my opinion, it's not worth stock picking anymore. Criteria number 2, very little or probably none at all small cap or mid cap companies or indexes, because they typically underperform the big cap indexes like the S&P 500. Next point, very little or none at all emerging markets or even developed economies outside of North America. So emerging markets would be things like Taiwan and China, Brazil, Russia, I guess, things like that. And developed outside North America would probably be things like Australia, Japan, and the big boys in Europe, right? Germany, England, France, Switzerland are the big ones. And this is simply because the US is king, the US dominates, and if you're in it for the long-term growth, chances are, or what I could see is that those markets typically underperform, or those regions typically underperform, not only Canada, but especially the United States. Also, next criteria, very little or probably none at all. Again, thematic growth ETFs or the trends of the day. If you're hearing about it, it's probably already too late to get in to make a big profit. So I'm talking about things like green energy, lithium, AI, robotics, cannabis at one point. Remember what happened to that? So, and I got burned myself. So any of the latest trends of the day, that's more, in my opinion, I consider that more speculating and gambling, not investing. Yes, you could get lucky and strike it rich if you get in at the right time. But typically when they make an ETF for something like that, it's typically already too late. Just my opinion here. Next criteria, I would go, this is an easy one, no brainer, 100% equity and stocks, no fixed income. Fixed income always underperforms equities over time. So what's the point? If you're a growth investor, you want maximum total return, you would not have any fixed income in your portfolio. You hear that 60-40, 80-20. I think personally that's nonsense. I would stick all equities all the time. 100%. Next, second and last criteria, I would actually have mostly US equity, even as a Canadian investor. And this is a no-brainer. It's simply because the US market is bigger. It outperforms Canada all the time. So, long term, of course, sometimes Canada could beat the US, especially recently because, let's say energy and materials are doing well, but technology is really, really doing bad. That's one of, 2022 is maybe a rare instance where the Canadian market was doing stronger than the US, but over time, the US is king. So I would have most of my equity most of my portfolio in US equity, but also some in Canada as well. And last criteria, I would put a small kind of like hedge or alternative in real estate. So maybe 5 to 10% in real estate, just, as a hedge or have to have some real estate exposure. So those are the general 7 criterias. Now let's check out the actual ETFs that I would consider if I was a growth investor. All right, everyone, let's start with the US. This is where the majority of my portfolio would be. Even as a Canadian growth investor, I'm talking, at least 70 to 80% would be in the US equity market. And in my opinion, the best option, or one of the best options you could ever have, all you really need is the S&P 500. Top 500 companies in the US. This is the king of kings when it comes to index funds. And on the Canadian market, you basically have 3 options. I would also go with the unhedged option. Not the Canadian hedge option. So we have 3 options. VFV, of course, from Vanguard. You have XUS is the iShares one, and you have ZSP from BMO. They all have very, very similar fees. I think they're almost identical here. So it's like tomato, tomato. Doesn't really matter which one you choose. 0.09. XUS is 0.10. Okay, so a tiny bit more. I'm not sure why this one is a bit higher. And then you got the BMO one at 0.09. So it doesn't really matter which one you choose, everyone. I would definitely make the S&P 500 a big part of my portfolio. And then a secondary or another option would be a NASDAQ 100 index ETF, which will be a little bit more tech focused, a little bit more growth oriented, and definitely a little bit more volatile. And you basically have 2 options, or I found 2 options on the Canadian market. ZNQ from BMO. Again, I would take a non-hedged one. So it would be ZNQ. Management expense ratio 0.39, so a little bit more than the S&P 500. And remember, a lot of these NASDAQ 100 companies are going to overlap with an S&P 500. So this is why I would maybe make the NASDAQ 100 a secondary position and make the S&P 500 a core or a primary position. But I did find HXQ from Horizons, which actually has a lower management fee. So the MER for this one, sorry about that, is 0.28. 0.28, so definitely lower than 0.39. So I would probably go with the Horizons one. I don't know why it's so much lower. Maybe it's on sale or something like that, but definitely very interesting here. This one here, HXQ. So this, ladies and gentlemen, I mean, between a combination of the S&P 500, doesn't matter if it's the Vanguard one, the iShares one, or the BMO one. This would be the majority of my portfolio to cover the US, and then probably a NASDAQ as a secondary position. So something probably like, I don't know, 50 to 60% in the S&P 500, 20% in the NASDAQ 100. So that would cover basically my US exposure. What about Canada? So in Canada, if you're a growth investor, I would strongly consider the leveraged non-covered call ETFs from Hamilton ETF. So of course, if you're total return investor, you don't want any covered calls, but a little bit of leverage doesn't hurt. And the Canadian market, let's get honest here, let's get serious, guys. The strongest thing by far in the Canadian market are the big banks. And what better way to get enhanced total return over time than an enhanced best performing Canadian banks ETF? That's right, I would go with HCAL. So HCAL, which only has the 6 banks, is managed by Hamilton ETFs. It has the 6 banks with 25% leverage. So this would be I would say probably the majority of my Canadian exposure, which would be somewhere around 20 to 30%. HFIN is also a good one to consider. It's the Canadian banks plus the life insurance companies, and you got some asset managers as well. So it's not just the banks. It does have Manulife, Sun Life, Great-West Life, Power Corp, and Brookfield. So a little bit more diversification within the financial sector. You also have HUTs. So if you just don't want the financials, you want to add a little bit of utilities and pipelines and things like that, HUTs is a great option here. So again, top utility companies in Canada, which, if you really think about it, energy utilities financials makes up the biggest chunk of the Canadian market. Probably materials is there too, but here you got 12 high dividend paying Canadian utility, telecom, and pipeline companies with 25% leverage. So these are the 3 I would consider greatly. I would make the majority for my Canadian coverage with HCAL, the biggest position, but it's okay to buy an index-based fund in Canada as well, like an S&P 500. So of course you have VCN from Vanguard, which is like buying all the Canadian stock market with very, very low management fee. Another great option is VDY. This, yes, only focuses on dividend companies. The yield is higher, however, and the performance has actually been really, really good. MER is a little bit higher, but if you look at the performance, you see in the last, let's see, 10 years, 9.35. And if you look at VCN, well, they don't have it here yet, but okay, let's check the 5-year, 8.46. And it's 9.72 for VDY. So I would definitely consider VDY, but VCN is okay if you want the whole market. XIU is another one where it's like the S&P 500 Canadian style, but it's 60 companies. If you want really the whole thing, like a VCN, that would be XIC. So this is VCN's competitor. XEI is VDY's competitor. So if you only want dividend stocks, like VDY, but you for some reason really love iShares, that it would be XEI. So just dividend companies. BMO has a Canadian general option as well called ZCN. So there you have it. These would be the options I would strongly consider for my Canadian exposure, everyone, with the majority probably in the best performing companies in Canada, the 6 banks. So the majority I would put in HCAL. So if my Canadian exposure is, let's say, 20%, I would probably put 10 to 15% in HCAL and the rest in any one of those other ETFs that we looked at. But I definitely like the Hamilton ones because that extra leverage, if you're a long-term growth investor, will help you definitely. And then for the real estate exposure, there's only one really to consider. It would be MREL. So MREL is completely beating VRE, XRE, ZRE. That's the index ones from Vanguard, iShares, and BMO. So I would definitely consider the middle field real estate dividend ETF MREL for my 5 to 10% real estate exposure. And I would also consider RS as well. So RS is a split share fund, which typically do covered calls, but they're not doing covered calls yet, everyone. So another option, if you want that maximum growth over time, you're going to drip it instead of MREL. And if you're comfortable with split share funds, of course, I am, and this is what I own in my income portfolio, but I would probably own it for my real estate exposure and my growth portfolio as well, is the real estate split corp. Stock symbol is RS. Now, I will share with you all-in-one options. I've talked about these before. So, yes, I go mostly with US and Canada, but it's not wrong to add these all-in-one growth options. And on the Canadian market, you basically have 3 of them. They're all very easy to remember because they all end with EQT. So VEQT is the Vanguard one, XEQT is the iShares one, ZEQT is the BMO one. And what these have, it's very simple. It's just a collection of their own indexes, which basically gives you access to the whole world. But the number one exposure is always going to be US. Right, so if you just look at the Vanguard one real quick here, you see 42.63% is the Vanguard US total, the US total market index ETF. So it's basically 43% exposure to the US, 30% Canada, about 20% developed outside North America, so Japan, Australia, Europe, and then you have a little bit in emerging markets. And if you look at the breakdown of XEQT and ZEQT, it's very, very similar. So the US is still number one. Personally, although this is a great option, I would stick with more with the S&P 500, but that's just me. So this, in short, everyone, hopefully you learned, you have an idea of what I would consider to be the top Canadian growth-oriented ETFs, and this is basically the ETFs that I would invest in if I was a growth investor. Hey, don't go yet. I have some important reminders, including some more recent ones, and I'll try to keep it as brief as possible. And for everything that I'm about to discuss, the links and info are in the video description below. So first of all, if you didn't know yet, I do offer a one-on-one coaching session where you'll have a 1-hour Zoom call with me where you could ask me all the questions you want, and I'll help you and assist you best I can. Just remember that I'm not a licensed or registered financial advisor or planner. So to book a session, go on my website, Passive Income ETFinvesting.ca, and right there on the homepage on the left hand side there is a small video. Watch that video to know how to book a one-on-one properly with yours truly. Also on my website you could purchase my digital product, the Ultimate DIY Investing Package, which is on version 4 right now. It comes with lifetime updates, so you only have to buy it once. And this is really a reference tool or a companion tool to help you build your own portfolio according to your needs and your objectives. It has lists of funds, it has sample portfolios for both Canadian investors and American investors, so make sure to check it out on my website. I actually created a video which shows the product from A to Z because I don't want you to spend money unless you know exactly what you're getting. So make sure to check that video out on my website. And don't take my word for how good it is. Check out the reviews. There's over 300 of them and they are all 100% real reviews. So here's some more updated news or recent news. I am now on Blossom, a new investing app designed for investors. I've been using it for a few weeks now. I think it's really, really great. It has a really cool feature where users could actually add and share their portfolios and what they're buying and selling every day. So you could actually link your investing account so it's updated automatically on a daily basis. I recently added my own main portfolio so you could follow how my portfolio is doing live and what I buy every month. Really, really cool. It's like a mix of Facebook and Twitter, but specifically for investing. So get on your phone, click on the link in the video description below and download the app. It's 100% free, so you too could share your portfolio. Just remember to look for me and follow me. My username is Adrian, PII altogether. Also, I do have a referral link for Questrade, so you could get $50 worth of free stock purchases. This is the Canadian discount broker that I use and I recommend. Unlike Wealthsimple, the other popular discount broker in Canada, you could drip everything you want. It has all the stocks and it also has dual currency accounts. Very, very convenient if you're buying both Canadian stocks and American stocks. I have a Questrade video, by the way, which gives you a little tour of the features, so make sure to check that out. I also have a referral link for PASSIV. This is the portfolio tracking tool that I use to consolidate all our accounts to get a nice bird's eye view, so you can consolidate all the information together for easy tracking and stats as well. Also, our Facebook group, Passive Income Investing, is now an invite-only private group. So to join it, you need to click on the link in the video description below and give the group a like to get invited. So we take pride in making this one of the best investing Facebook groups out there with over 13,000 members. There's no scams, there's no spammers, and negative and doomsday people, we kick them out right away. Also, follow us on Instagram if you want a little bit more of our personal journey here in Panama. And lastly, just remember everyone, I am not a licensed or registered financial advisor. This channel is all about my personal investing journey and how I invest to generate high passive income from a diversified portfolio of high yield funds. It's for educational purposes only, so don't forget to do your own research and due diligence. And of course, stay safe everyone, stay healthy, and of course, stay passive. See you next time.